Hi, and welcome to this week's episode of the Cost of Carry podcast. Today, I am joined here with Aaron Sainsbury from St. George Residential, and today we will be talking about a range of things, such as how coronavirus has impacted residential lending, St. George's policies, and how to best submit an application to St. George. Before we begin, this interview was recorded before this introduction, and I would like to note that at the time of this recording, several changes have been put in place by St. George in relation to their COVID-19 policy. For more terms and conditions about how this will affect your application or whether or not this policy is suited to your needs, feel free to reach out to the team at Ding Financial or your local St. George BDM banker. I hope you enjoy this interview. Stay tuned for more. Thank you very much, Aaron, for joining me today. For those of you who don't know, Aaron is the St. George BDM for residential lending. So, Aaron, how about you introduce yourself and St. George to all the listeners out there?
Absolutely. I would hope that St. George Bank doesn't really need much of an introduction. We've been around for a little while. A few years ago, acquired by Westpac Banking Group, so now one of Australia's biggest banks and biggest home loan lenders. Myself personally, my name is Aaron Sainsbury. I've been in the finance and lending industry for just over 16 years now. 15 of that was as a mortgage broker myself, and I recently joined St. George Bank on the 1st of March 2019, in fact, as a BDM. So just fairly new to this side of the equation, but pretty well versed in how the home market works.
That's many years of experience. And I think, like, as you mentioned, St. George is a very well-known brand in the Australian lending space. I mean, is there something that you feel as though most borrowers don't realise St. George is really good at something in the residential lending space, like for certain types of borrowers or certain types of securities or deals like that?
Yeah, one policy niche that we have that I find brokers either tend to forget about or underutilize or maybe aren't even aware of is our parental leave policy. A lot of lenders have a parental leave policy, but most have a sunset period on that. So they'll only consider it if the person that's taking parental leave is going to be returning to work within a given period of time. That might be 6 months or 12 months, and you'll need to evidence that. But with our policy, there's no requirement to demonstrate that they're going to be returning to work within any particular given period of time. It's just a consequence of being able to obviously have some confirmation in writing from the employer that they will be returning to work and what the return to work conditions and remuneration will be. But as long as we can mitigate whatever that difference is, so if there's going to be a shortfall in income for the period while they're on parental leave, as long as we can show that there's some financial capacity to meet that shortfall, then we'll consider the application regardless of how long that period is.
Oh, well, that's amazing. And I suppose in this era of Corona as well, or this environment of Corona, does St. George or yourself view some of these issues contextually in each of the applications that you receive? So, for example, when it comes to income and employment.
Yeah, absolutely. So as yet, at the time of recording this, we haven't actually had any official policy changes as such as a direct response to the COVID threat. However, any policy would always be viewed under the lens of responsible lending in any case. And so our credit advisors and our credit assessors are in fact looking at every application on that basis. So if they see an application that comes through from somebody who is engaged in an industry or field that we feel is likely to be under significant threat because of the COVID virus, then credit managers are going to ask some questions about that, just in order to be able to be satisfied that there is going to be some continuity of employment and continuity of income, because obviously we don't want to be putting people into a circumstance where they're immediately going to find themselves challenged to make their home loan repayments. That's not good for anybody.
Absolutely not. And I suppose that because there's so many moving parts to the lending process, like obviously you've got the employment and the servicing, but you've also got things like housing prices, small business activity for self-employed borrowers. So I suppose also St. George is also going to take, I wouldn't say
microscopic look, but they're definitely going to be very aware and very alert to changes that borrowers may experience.
Very much so, yeah. And our economists are obviously looking at those sorts of things fairly regularly, and there's generally a weekly update that comes out from our senior economists in relation to their outlook on the market, etc. So, and that obviously in recent times that's taken account very much of the impact that COVID has had on, and we expect will continue to have on the economy.
Absolutely. And I suppose leading into that, before COVID or before any of these changes, was there a type of borrower that fit really nicely into St. George's portfolio?
Yeah, look, St George, because we sort of started off as a small regional building society, we still very much play to that market, even though we're owned by the Westpac Group. There still is very much a differentiation between the brands. So the market that's targeted by St George is quite different to the market that's targeted by Westpac. So you'll find very much that an ideal customer for Westpac Bank will look fairly different to an ideal customer for St George Bank. And typically an ideal customer for St George Bank is really, just the heartland, the mums and dads, the first home buyers, and the PAYG investors who just want to start investing in property and try to get ahead. But our customers typically are not your sort of your really high end, high net worth customers. They're not the sort of the big end of town guys. It's the mums and dads that really is our heartland. That's our sweet spot.
No, absolutely. And I suppose that's pretty much the backbone of, the Australian economy. Mum and dad borrowers, first home buyers looking to get their foot in the door. But when you look at the profile of the new borrowers that are coming through, St. George is really well placed outside of the four majors to get some market share in that area as well.
Very much so, and we've seen that growing. I just saw some statistics earlier this week from Momentum Intelligence, who are one of the publishers of a lot of the industry journals, Advisor Magazine, that sort of stuff, and that was showing that St George's market share of the broker market has in fact grown fairly significantly in the last quarter, and I think that's probably because we fit into a really sweet niche market. We're not really seen as one of the big four, but we're seen as being a really comfortable, solid, secure alternative because we are owned by the Westpac Group. So we've kind of got the best of both worlds by having a bit of a foot in each camp, really.
Absolutely. And with that being said, I wouldn't say there's a lot of sharing going on between every institution, but I would imagine there is some technological aspects that St. George also gets from Westpac and vice versa. And especially in this environment, technology is at the forefront of everybody's lips when it comes to verification of ID, easy document signing and things like that. So how does St. George make it easier for borrowers to complete their loan in this area where you can't go face to face and see people?
So we're continuing to roll out a number of options at the moment. Late last year, before any of the COVID virus became a threat, we went to market with our e-sign documents process, and that's been received really well by the market. We're actually, at this point, I think I'm safe to say that we're actually offers e-sign not only for the loan offer documents, but also for the mortgage documents themselves. In instances where the security property is based in either New South Wales or Victoria. So I don't think, I know there are other lenders that actually offer e-sign but still need a paper mortgage. So our process for e-sign is really, really comprehensive, and the whole process is online. We've recently also introduced some changes to verification of identity so that can now be done by way of a virtual appointment rather than actually having to have a physical face-to-face meeting with customers. And we're actually in a process now in fact, I think the communications went out earlier this week in relation to some further support around that in terms of virtual signing of documents where e-sign isn't available, because in some instances e-sign isn't going to be available depending on the type of transaction. So, for example, if it's a transaction involving a family pledge guarantor, certain title types and things like bridging loans and relocation loans, we can't use e-sign with those. So we've actually came up with a method of being able to have a virtual meeting via Skype or Zoom or whatever platform and signing the documents that way.
And I suppose that accessibility factor is a major consideration for most borrowers. And extending that further, that must appeal to most borrowers who just want something where it's near contactless and is very streamlined. And I think having read the media around it, seems to be a major selling point for you guys as well.
Yeah, I think that's safe to say. I do occasionally get feedback from people who are, concerned that their customers might not necessarily be very technology savvy and might not be comfortable with some of those processes. But I think what we've learned in the last month or so from, sort of the new way of life with the COVID virus, and having to be more dependent on technology and working from home and so on, I think what we've learned is that most of us can adapt pretty easily to that. And I think that I wouldn't be surprised if we find that even post-COVID, that our uptake of some of the virtual solutions that we've implemented as a temporary measure become a little bit more than temporary, to be honest.
I definitely agree. I wouldn't say it's a tipping point for the industry, but I definitely see it as a tipping point for a way of our attitude towards it. Whether or not there's massive uptake is a separate question, but it's become very apparent that without technology, we can't walk out the door. Our mobile phones are the remote control of life, as I've heard many times before, and I think having that accessibility is really helpful for most people. So on that note, when someone is in that situation where they are submitting an application to St. George or they are in the process of it, what's something that they can do to make their application a little bit more complete and it's more appealing for someone who's assessing it at St. George?
So I would suggest probably two things, and none of it's really brain surgery. It's really simple stuff. So the first thing would be to, as a broker, make sure that you're using the checklist. There's a minimum document requirements checklist, and use that. Every BDM that you ever talk to and ever ask that question will give you the same answer, right? But it really is that simple. Just use the checklist. And if you provide everything that's required on that checklist and provide it in its complete form, then you should have very few problems. The other thing that I'd really strongly suggest in an era where we've moved to comprehensive credit reporting, I would suggest that you're probably doing your customer and yourself a really strong disservice if you don't get or encourage your customer to get a copy of their own credit file before you submit the application, because we're certainly going to get that information. So if you know what's on that file before you submit it to us, you're a little bit ahead of the game, and you can perhaps potentially even anticipate what questions might come up and be prepared to answer them before they're asked.
And also with comprehensive credit reporting also comes best interest duty as well. So that whole idea of the broker being fully engaged in terms of understanding the borrower's needs, explaining to them that price isn't everything or rate isn't everything, and explaining to them that sometimes products are actually designed in a way to help them rather than work against them. And I think with St. George's policy, nearly on the forefront of what's coming straight out of the regulators from the government as well.
Yeah, look, we try to be, and that can tend to be a double-edged sword, right? So if the move is by way of tightening policy because that's necessary to do, then it's never a really popular move to be the first one to move on things like that. So it can be a bit of a double-edged sword. But yeah, look, we tend to try to be at the forefront of those sorts of things, and we also try to frame our policies in such a way as we're providing solutions to customers. And I think that's what your best interest duty is about, is understanding those policies and niches and how those policies and niches differ from one lender to the next, so that you can really advise your customer what's going to work best for them in their moment of need. Because it's not always that interest rate is the be all and end all. Look, in some cases, customers will just simply come to you and their needs will be fairly straightforward. They just want to buy a home and they just want to get a straightforward mortgage that they can pay off as quickly as possible. And in that case, it might be that the most important factors for them are interest rate and fees. But you might then also get somebody come to you who has found their dream home, but they haven't even considered putting their property on the market yet. So in that case, our relocation loan is probably going to be second to none other in the market in terms of the way that our policy works. There are very few lenders that do relocation lending as well as we do it. We'll do it for construction loans where others won't. We'll do it above 80% LVR where others won't. We'll do it where there's no end debt where others won't even consider those. So there's a lot of areas where our product works really well for people and our policy works really well for people.
Definitely, you hit the nails right on the head. It is more than just price. And one of the other points, which is on the tips of everybody's tongue, is also relating to household debt. So depending on how much you can say, do you or St. George have any thoughts on that when it comes to household debt nearly being 200% of income?
No, I don't think that there's necessarily any particular concern beyond what's already been expressed in the broader market and political landscape. We did make some changes to policy last year where we've introduced a requirement to have a debt to income ratio as one of the metrics that we consider now, whereas we previously didn't do that. That doesn't necessarily mean to say that because your debt to income ratio is higher than a particular amount, and with us the cutoff is 7, if it's higher than 7, it doesn't necessarily mean that the application won't be approved. It just means that it might need a bit more scrutiny, and so we might need to understand who is that customer and why is their debt to income ratio as high as it is. I think the appetite has changed somewhat on the basis of those things, but I don't know that there's necessarily any move to continue to tighten on those sorts of parameters.
And Aaron, before we close off, is there anything else that you would like to mention to the listeners out there about what you and St. George have got going on?
No, at this point in time, we continue to be very much open for business. Most of our staff in the various areas of the business are working from home at the moment. So I'm actually enjoying that personally. It works quite well for me, but I'm aware that other people in other parts of the business are finding that maybe a little bit more challenging. So in some cases, the way that we do business has been impacted to a degree by the changes that we've had to make. But no, we're very much open for business and very keen to fulfill the Westpac vision of being one of the world's leading service institutions.
No, that's fantastic. And I suppose on that note, just being supportive of local businesses that are doing it tough and vulnerable people as well in the community, that also is a great way to keep the spirits up. Aaron, thank you very much for your time. Really enjoyed the conversation today and I look forward to speaking to you soon.
Thanks, James. Great to talk to you.